Good day, welcome to today's class. If this is your first time on this channel, please click the red subscription button below this video to subscribe so that when we drop more educative content, you can have access to them. So this is my second class on capital allowance. If you have not seen the first video class, you can check right under this video. I will drop the link there to it. So in this class, I'll be explaining what we mean by some other terminologies of capital allowance, and I will shed more light on investment allowance, and we take a question, a very technical questions, and we solve together. So firstly, what do you mean by balancing charge and what do you mean by balancing allowance? Okay, I will give an illustration. Let's say, for example, the tax written down value of an asset is 1 million. I've explained the meaning of tax written down value. I said if the cost of an asset is 10 million naira and you've already enjoyed or you've been granted a capital allowance of 2 million. So the value of that asset is not 10 million because government has paid you 2 million as capital allowance, or government has granted you relief. Let me put it that way, because government don't pay, they will grant you relief in terms of tax liability. I've explained that in my previous video. So that means that the value of that asset now is 8 million. So that is the tax written down value. So if the tax written down value of an asset is 8 million and you sold the asset for 10 million, there are some times whereby you feel like I need to buy a new machines and these old ones I want to sell them. So you sold them at a value, a machine that is worth 8 million, you sold it at 10 million. That means you made a profit of 2 million. So that 2 million will be subjected to tax. Yeah, because you've made a profit from selling it. And that profit you made is called balancing charge. So tax will be charged on it. So balancing charge is when the proceed you made from selling your asset is greater than your tax written down value. And balancing allowance is the opposite. If the tax written down value of an asset is 8 million and you sold it for 6 million, that is a loss. So in that situation, government will grant you relief. So it's like vice versa. You make a profit, government will tax you. You make loss, government will grant you relief. So that is what we mean by balancing allowance and balancing charge. But in my subsequent videos, we take a complete video lecture on loss, relief, and all of that, so you get it better. But for the sake of this class, we will take a question together, and in this question, I will shed more light on investment allowance. So we have a company commenced business on February 1, 2020 and makes up its account to March 31st every year. I said it that you need to be taking note of when the business wants to be making up their accounts. So for this business, we have it to be 31st of March. 31st of March of every year. So let's just note it that way. So makes up its account to 31st of March every year. It acquires property, plants, and equipment as follows. So the date 1st of February 2020, acquired building for 5 million. 1st of February 2020 also acquired furniture for 1.5 million. 1st of April 2020 acquired machinery for 2 million, and 3rd of May, yeah, that's fifth month, May 2020, acquired Jeep motor vehicle for 3 million. So the turnover of the relevant assessment year was over 27 million. So we're told to calculate determine the basis period, complete the capital allowance for all relevant years, taking into consideration the provisional year. So we are going to solve this question together, and this is the kind of question you should expect in exams, in professional exams. So a company, we are not giving the name of the company, just so that a business commenced business February 1, 2020 and bought some assets. So we have building, furniture. So let me clean this. We have building, furniture, building, furniture. We have machinery, and we have Jeep motor vehicle. I'll represent it as just Jeep. Now, they said the business makes up its account to 31st of March. So that means that they close their books of account, they end their book of account 31st March of every year. Now, they bought a machine 1st of February 2020, that means it still falls within the accounting year, because they close their books of account 31st of March, so they are buying 1st of February. They are buying 1st of February, so that 1st of February still falls in 2021, because we are using preceding year basis. Don't forget, I want you to keep all these things at heart. We are using preceding year basis, and don't forget that the tax of 2020 will be collected in 2021. So if I'm saying 2021, I mean, if I'm saying 2021, I mean 2020 relevant assessments and adjustments. So 1st of February 2020, 1st of February 2020 falls in 2021 tax year, and 1st of April 2021, 1st of April 2021 falls 3rd of May 2020 falls in 2022 relevant tax year. I've explained that in all my previous videos. You can check out my previous video if you don't really get it. So now we are given the allowance for each. We are given the allowance for each. We are given the investment allowance, investment allowance, investment allowance. So 0%. Don't forget that I said that in exams also you'll be given the percentage: 0%, 10%, and 0%. So, and I also said in my initial video that investment allowance is only for plant and machinery or plant and equipment. Yes, that is why you see 0.000% here, and machinery 10%, because investment allowance is just for plant, machinery, or plant or equipment, any of those four. So the next one, we have the initial allowance. Initial allowance, we're given their percentage. Building is 15%, 25%, 50%, and 50%. Yes, initial allowance. And we have the annual allowance. Annual allowance of 10%, 20%, 25%, and 25%. So these are the allowance that we're being given. The percentage: investment allowance, initial allowance, annual allowance. So now all these assets are being purchased in 2020, but we have the building and furniture were purchased on the 1st of February 2020. 1st of February 2020. And don't forget that I said it already, the business closes their account 31st of March every year. So definitely 31st of March 2020, they will close the accounting year for 2020, which the relevant tax year will be charged in 2021. So the first year of assessment, now we have 2021 year of assessment. So 2021 year of assessment, we have what is the costs, and what is the, now for 2021 year of assessment, it's only building and furniture that will only reflect, only building and furniture. And the reason is because by the time all these ones are being purchased, like furniture now from the question was purchased on 1st of April, 1st of April, and our account ended 31st of March. So that's 1st of April is a new year. So it will not reflect in 2021 year of assessment. That is why the dates in which the business will end is very, very important. If there's any mistake students do make, it's on this particular aspect. So let's go. Costs. What is the cost of building? Building is 5 million naira. 5 million naira. Furniture is 1.5 million naira. 1,500,000. So I'm not gonna include all this because it's not yet their time. So this one does not have any investment allowance, is 0%. Furniture does not have investment allowance, 0%. So I'll move straight away to initial allowance. So I'll come here, initial allowance for building is 15%. So I will apply my 15%. So 15% of 5 million. 15% of 5 million is 750,000. 750,000. So therefore, the next one to charge now is the next one to charge now is furniture, and the initial allowance from the question is 25%. So 25% of 1.5 million naira, because the amount of furniture is 1,500,000, 1,500,000, and that's 375,000. That's 375,000. Good. I've charged my initial allowance, which will be subtracted. Let's put them in brackets because they will be subtracted. So the next thing I need to involve, or I need to calculate now, is my annual allowance. Annual allowance. And if you watch my first video, I said the annual allowance, before you can calculate the annual allowance, you need to subtract the initial allowance from the costs. Then the rest is what you will now charge your annual allowance on. So 5 million naira minus 750,000. 5 million naira minus 750,000 gives us 4,250,000. So 4,250,000. For building, my annual allowance will be charged on this. So annual allowance for building is 10%. So 10% of 4,250,000, 10% of form is 425,000. 425,000. But I need to ask myself, this 425% is annual allowance for a year. Does this asset, during the period at which we purchase them till the year end, is it up to a year? We purchase them 1st of February, according to the question. We purchase them 1st of February 2020, and we close our account 31st of March. That is just 2 months. Yes. So because 1st of February, that's the beginning of February, the whole of February, and 31st of March, the whole of March. That's just 2 months. So if I'm charging 425%, which is for a year, for just 2 months, it's not fair. So I need to remove the 2 months from this 425,000 and charge it as my annual allowance. You see why you need to consider the time at which the business ended. Is very, very important. So now 2 months out of 425,000, that's 2 over 12 times 425,000. So 2 over 12 that will give me 70,833. 70,833. So I'll put it in brackets because it's meant to be subtracted. I'll do the same thing for my furniture. I have my cost to be 1,500,000, my initial allowance to be 375,000. So 1,500,000 minus 375,000, that will give me 1,125,000. 1,125,000 as my remaining balance that we charge my annual allowance on. So, but if I'm to charge my annual allowance now, my annual allowance for furniture is 20%. So 20 divided by 100 times 1,125,000. That gives me 225,000. 225,000. Now, this 225,000 is the annual allowance for a year. But if I charge it, I'm not fair because it's just 2 months. So I'll just say 2 divided by 12 times my answer, which is 37,500. So for this month, or for this 2021 year of assessment, I'm only going to charge 37,500. 37,500. So 500. So for the 2021 year of assessment, what is the tax written down value for these two assets? Tax written down value for the two assets will be 5 million minus 750,000 minus 70,833. So 750,000 plus 70,833. Then I can subtract 5 million. I can subtract it from 5 million. That's 4,179,167 is my tax written down value after 2021 year of assessment. Then let me do the same thing. 375,000 plus 37,500. Then I'll subtract it from 1,500,000. Oh, 1,500,000, sorry, 375,000 plus 37,500, then 1,500,000 minus answer. That will give me 1,087,500. 1,087,500. So the tax written down value for 2021 year of assessment for building is this, and for furniture is this. That's how to do that. So now moving to the following year, which is 2022 year of assessment. 2022 year of assessment. For 2022 year of assessment, what is my tax written down value of building? Now, building cannot later attract initial allowance, because I said it that initial allowance is once and it does not have investment allowance. So the only allowance that we can charge on building is annual allowance. So good. So let's continue. So for the 2022 year of assessment, what is my tax written down value? It's already this. This is it here. For furniture is this. But in that year, we purchased machinery and we purchased jeep. So what is the cost of my machinery and what is the cost of my jeep? The cost of my machinery is 2 million. Is 2 million, and the cost of my jeep is what I'm having here, I think it's 3 million. Yes, 3 million. So can you see how we calculate capital allowance? So now, but the dates they were purchased, I think they were both purchased 1st of April. So yeah, let's confirm the date so that we can be sure of what we are solving. Is very, very, very important. Yes, this was purchased 1st of April, yes, which is the beginning of a new accounting year, and the second one was purchased 3rd of May, April, May. Okay, so this one actually completes 12 months, because the business ends 31st March and a new accounting year is starting 1st of April. And according to our question, machinery was purchased 1st of April and jeep motor vehicle was purchased 3rd of May. So we can say jeep motor vehicle spent or used 11 months, while this used 12 months. So let's solve according to that assumption. Now, for machinery, there is investment allowance of 10%. So investment allowance, I will start with that. No, sorry. Yes, investment allowance. Investment allowance. Investment allowance. Will all this attract investment allowance? No, they don't have investment allowance. So just push dash, push dash. So for machinery, investment allowance is 10%. So 10 divided by 100 times 2 million, that's 200,000. And investment allowance of 200,000. For jeep, is there investment allowance? No, so put dash. Then the next one now is for an initial allowance. For initial allowance, now for initial allowance, building cannot attract initial allowance because initial allowance is just once, so still dash. Same thing with furniture dash. Initial allowance for this one is 50%, and I said initial allowance, whenever you want to calculate initial allowance, you don't include or you don't subtract investment allowance. Yeah, so my initial allowance, which is 50%, will be on the cost, which is 2 million. So 50% of 2 million, that will be 1 million. So 1 million. And this also, initial allowance is 50%. So 50% of 3 million, that is 1,500,000. So they will be subtracted. We put them in brackets because they will be subtracted. That is why they are allowance. So the annual allowance for machinery is 25%. Annual allowance. Now, building we surely have annual allowance. Furniture we surely have annual allowance. So my annual allowance, I have calculated it the other time, but we did not write it down. Let's recalculate it. There's no problem. Now, my annual allowance is my costs minus my initial allowance, then the rest I will charge my annual allowance. My cost is 5 million minus 750,000. So that is 4,250,000. Then my annual allowance, which is 10%, will give me 425,000. So for building, the annual allowance is 425,000. And for furniture, the cost minus the initial allowance, then the rest 10% of it is the annual allowance. So 1,500,000 minus 375,000, which is the initial allowance. Sorry, for furniture, the annual allowance is 20%. So, and that's 225,000. 225,000 for its annual allowance. Now, what is the annual allowance of this? To get the annual allowance of this, I've already said it, that your costs minus your initial allowance, cost minus your initial allowance, then that is what you are going to calculate your annual allowance on. Your cost here is 2 million, investment allowance is 200,000. You don't have any issue, you don't have any concern with it. Cost is 2 million minus initial allowance, which is 1 million. That is 1 million. So charge 25% of 1 million. 25% of 1 million. That is 250,000. 250,000 as my initial, as my annual allowance. And for this 25%, so 3 million minus your initial allowance, which is 1.5 million naira, and that will give you 1.5 million naira. So charge your 25% of 1.5 million naira, 25% of 1,500,000. That will give you 375. 375. But if you look at it, this Jeep was purchased 1st of May. The business started 1st of April and it was purchased 3rd of May. More or less like it did not start from that April, it started from May. So we cannot say it is 12 months, no, it is 11 months. So this 375,000, instead of charging the whole 375,000, I will charge the one for 11 months. And that will be 11 over 12 times 375,000. You get the, so times 11 divided by 12. That's 343,750. 343,750. So that would be the initial. Yeah, that will be the initial. So now let's calculate the tax written down value for all the assets. Tax written down value for all the assets. Tax written down value for this building will be 4,179,167 minus this. This also minus this. But this, and I said it also that if you want to calculate the tax written down value of an asset that has investment allowance, please don't subtract your investment allowance. The tax written down value is your cost minus initial allowance minus annual allowance. I don't just want to cause confusion. I will have said let me break it down, but no, not in this class. Probably in another class I will explain why you don't subtract investment allowance. So my investment allowance here will be 2 million. This 200,000 is my investment allowance. I'm not subtracting it. 2 million minus initial allowance, which is 1 million, minus annual allowance, which is 250,000, will give me my tax written down value, and that's 750,000 for machinery. And for Jeep, 3 million minus the initial allowance, which is 1.5 million, will give us 1.5 million, and 1.5 million minus 343,750. So 1,500,000, 1,500,000 minus 343,750 will give me 1,156,250. 1,156,250. Then let me calculate that of these ones. So 1,087,500 minus 225,000 will give me 862,500, 862,500, and 4,179,167, 4,179,167 minus 425,000 will give me 3,754,167, 3,754,167. So this is the tax written down value for the four assets. So we've come to the end of this class. I hope you understand. If you are still finding issue to get anything, please take your time to take the video back and watch it again. It's a very interesting topic and a very simple topic if you understand the concept. And I would like you to click the red button under this video, subscribe to my YouTube channel so that when I'm dropping next video, you will get notified and you will get to see it. Thank you. See you in our next video class.